Your phone rings. It's your brother or your cousin. And you can hear the panic in their voice because someone at the funeral just said, "The IRS is going to take 40%. And now your family is staring at a house, a retirement account, maybe a small business, and wondering if inheriting anything is about to turn into a tax disaster. Then you find out the truth, which is that for most families, the federal estate tax isn't the monster under the bed, because there's an exemption so big that it quietly wipes out the tax for the vast majority of people. And the only real tragedy is when someone could have used it intelligently, but missed one simple paperwork move. My name is Hector, and I translate confusing tax rules into decisions you can actually make without losing sleep. Here's why this matters. Even if you don't think you're estate tax rich, because the exemption is not just a number. It's a planning lever that affects gifts while you're alive and what happens when you die. If you misunderstand how it works, you can accidentally waste a benefit worth millions, or you can focus on the wrong tax entirely and miss the real issues that hit normal families, like state estate taxes, beneficiary mistakes, and the difference between estate tax and capital gains. Stick with me until the end, because the most expensive estate tax mistake is not paying the tax. It's failing to file one form that can transfer a massive unused exemption to a surviving spouse, and it's the kind of mistake families only discover after it's too late to fix. So let's start with the secret, and it's only secret because nobody talks about it. The federal estate tax has a basic exclusion amount, which most people casually call the estate tax exemption, and it's essentially a giant coupon that shields a big chunk of your transfers from federal estate tax. In 2026, that exclusion amount is $15 million per person, which means you can pass up to that amount, counting certain lifetime gifts and what you leave at death, before the federal estate tax even becomes a conversation. Now, that sounds like a headline, but the key detail is what happens above the exemption, because that's where the scary 40% number comes from. The federal estate tax rate tops out at 40% on the amount above the exemption, which is why truly large estates plan carefully. But the exemption is so high that most estates never reach that taxable zone. And that's why so many families panic over a tax they will never actually owe at the federal level. At this point, you might be thinking, so if the exemption is that high, why should I care? And the answer is that the exemption is unified with the gift tax, which means it's one combined lifetime bucket, not two separate buckets. In plain English, the IRS is saying, you can transfer up to this amount during life or at death without federal gift or estate tax. And every time you make a taxable gift, you're quietly spending down the same pool you would have used later. This is where people get tripped up because most gifts are not taxable in the day-to-day sense, and the reason is the annual exclusion. In 2026, you can give $19,000 per recipient per year without even touching your lifetime exemption, which means you could give that amount to your child, your niece, your friend, and your neighbor, and the annual exclusion applies separately to each recipient. If you're married and you do gift splitting properly, you can effectively double that per recipient, which is why some families move meaningful money over time without ever using the lifetime bucket. But here's the crucial point that keeps you from doing something dumb out of fear. Filing a gift tax return does not automatically mean you owe gift tax, because for many people it simply means you reported a gift that exceeded the annual exclusion, and the IRS tracked it against your lifetime exemption. You only get into actual gift tax payments when you've burned through the whole lifetime amount, and most people never get close, which is exactly why the IRS's secret exemption is so powerful when you understand it calmly. If this is already making things clearer, subscribing is worth it, because this series is basically about turning scary tax myths into simple, defensible moves that protect your money and your family. Now we need to talk about the biggest hidden win inside this system, because it's where real money gets saved. And it's also where families accidentally lose millions through inaction. It's called portability. And the simple version is that when the first spouse dies, any unused estate tax exclusion can be transferred to the surviving spouse, but only if the estate makes the portability election. Here's what makes that so important. A lot of married couples are nowhere near 15 million individually, but together they might be closer than they think once you count the house, retirement accounts, life insurance, business equity, and a couple decades of market growth. If the first spouse dies and the family doesn't elect portability, the unused exclusion can vanish, and then the survivor dies later with one exclusion instead of potentially two, which is when an estate that could have been sheltered becomes partly taxable. The brutal part is that portability requires filing a Form 706, the federal estate tax return, even if no estate tax is owed. And that feels backwards to people because they assume no tax due means no need to file. In reality, the filing is the act that locks in the survivor's right to the deceased spouse's unused exclusion, and skipping it is the kind of mistake that can't be fixed with a phone call once the deadlines pass. Now, before you assume this is only for the ultra-wealthy, remember that estate doesn't mean cash sitting in a vault, because the estate includes a lot more than most people intuitively count. Your gross estate typically includes your home at fair market value, your investment accounts, retirement accounts, business interests, vehicles, collectibles, and often life insurance proceeds if you own the policy in certain ways, which means a family can feel middle class in cash flow and still have a surprisingly large estate on paper. This is also where people mix up two different taxes and end up planning for the wrong monster. The estate tax is about the value of what you transfer. The capital gains tax is about the gain embedded in assets. And the reason that matters is the step-up in basis. Many inherited assets receive a step-up in basis at death, which can reduce capital gains for heirs when they later sell. And that means for a lot of families, the bigger practical benefit of good estate planning is not avoiding estate tax, it's preserving the step-up, keeping beneficiary designations clean, and avoiding forced sales or probate chaos that turns taxes and fees into unnecessary losses. So what should you actually do with this, especially if you're thinking, I'm not worth $15 million, so I'll ignore it? You focus on the moves that create the most protection with the least complexity, because that's where normal families win. First, you get your beneficiary designations aligned with your actual plan, because outdated beneficiaries on retirement accounts and insurance policies can override what your will says. And that's how money accidentally goes to an ex, a sibling you didn't intend, or into an estate that creates avoidable delays and costs. Second, if you're married, you talk about portability early, because it's a decision that only matters when someone dies, and you don't want your spouse trying to learn Form 706 in the middle of grief. Even if you think your net worth is modest today, you should think in future value terms, because time, inflation, and asset growth are what turn "we're fine" into "we should have filed." Third, you remember that federal estate tax is only one layer, because several states have their own estate or inheritance taxes with much lower thresholds than the federal level, which means you can be nowhere near the federal exemption and still face a state-level hit depending on where you live and where property is located. Fourth, if you're in the zone where lifetime gifting makes sense, you do it with intention, not panic. Because the best gifting strategies are usually about slowly moving assets over time using the annual exclusion, paying certain expenses directly when allowed, and documenting properly, rather than trying to dump assets in a way that creates reporting problems and family drama. If you're getting value from this, hit like, because it helps push the practical tax explanations above the fear-based ones that make everyone think the IRS is waiting behind every door. Now let's bring it back to the title, because the $13 million secret is really shorthand for a moving target that's been around that size in recent years and is even larger in 2026. And that matters because these numbers can change with legislation. That means smart estate planning is never about betting your family's future on today's exemption staying forever, because it's about building a plan that still works if the exemption rises, falls, or gets redesigned. And the way you do that is by focusing on clean documents, clear ownership, and the few elections that lock in benefits you're allowed to have. So here's the simple takeaway that you can remember without a spreadsheet. The federal estate tax exemption is a huge shield. It's shared between gifts and estates. And the most common expensive mistake is not owing estate tax. It's failing to preserve options for a surviving spouse and failing to keep your plan consistent across wills, trusts, and beneficiary forms. If you want a practical tool for this, I have a one-page estate tax exemption explainer that shows you how the lifetime bucket works, how the annual exclusion fits in, and a portability checklist your spouse can actually follow, because the goal is not to turn you into an estate lawyer. It's to make sure your family doesn't lose a benefit worth millions just because nobody filed the one form that mattered. And once you've got that covered, you can stop fearing the estate tax boogeyman and start focusing on the moves that protect real families, which is exactly what you do when you make the paperwork boring now, so the money stays in the family later. And the next time someone whispers 40% at a funeral, you'll know whether it's real or whether it's just another myth that sounds scary because nobody ever explains the rules out loud. Sources, not for voiceover. IRS inflation adjustments for 2026 basic exclusion amount and IRS estate and gift tax guidance, including the 2026 $15,000 threshold, the 2026 $19,000 annual gift exclusion, and Form 706 portability requirements.